This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This video is going to go through and talk our way through the question called Emcee. You will find that on the ACCA website. It is in the P2 resources. It's in the P2 past exams. They are the international variant, and you will find it in the hybrid paper from June 2016. Whether it was in a March paper, whether it was in the June paper, we don't know. To be honest, we don't care. Okay, we just want to go through there, don't we? And have a look how to answer it. So hopefully you've got a copy of it in front of you there. Like all of the accounting standards questions, whether that's question 2 or 3, we adopt a similar approach, don't we? So we need to read and understand the requirements, which is there in bold at the bottom. And whilst you're doing that, allocate the time available to answer the question. Again, it depends upon your approach and how you use the 3 hours and 15 minutes. If you use the full 3 hours and 15 minutes to answer the exam, then it's 1.95 minutes per mark. If you decide to go with the older approach, whereby you take the 15 minutes of the exam as reading and planning time, and then use the 3 hours to answer the questions, then you're giving yourself 1.8 minutes per mark. Okay, it's up to you. But remember, that's 1.8 minutes from when you start after the first 15 minutes of the exam. Okay, so you've got the requirement there. I don't think there's anything different too much to what you've seen on previous questions. Again, professional marks for clarity and quality. So clarity using headings, subheadings, starting a new part on a new page, subheadings, trying to structure your answer in an easier, understandable fashion. And then in terms of the quality, we're thinking as well, full English sentences. Again, be brief to the point, but make sure you write in full, proper English. Should be 2 easy marks there. You can see the mark allocation against each question. We can talk about that in a moment. And then again, the main requirement is talking about IFRSs, which you'd expect in an international paper, and discuss how the events will be shown in the financial statements. So we're thinking balance sheet, statements of profit or loss. Did I say balance sheet? Statements of financial position, statements of profit or loss, and statements of cash flows. Okay, and then make reference to the IFRSs. Don't just list out the rules. Make sure that you apply it to the specifics that you have within the scenario. So that's a very general requirement, isn't it? Okay, and people will just take that to think, well, right, I'm just going to write down everything I can remember from the standard. No. Make sure you go to each section and understand the specific requirement, because it goes into a bit more detail within there. And then go through and look at each section as well and see how many marks you need to pass. Okay. So if we look at the specific requirements, they're always contained at the end of each section. So if you look at part A, the last sentence, it says that Emcee needs advice on how to treat the borrowing costs in its financial statement for the year ended May 2016. It's about borrowing costs. It's wanting you to look at how we treat them. Do you know anything about borrowing costs? Hopefully you do. It's brought forward knowledge. Is it from F7? But it's going to be tested in a P2 fashion, so a little bit more complex will be the scenario. 6 marks. To pass, you need 3. So 3 well-explained points. Hopefully you should be able to get that there. Part B. I think part B was probably the more difficult bit of it all. It says it would like to know the financial reporting treatment of an acquisition, extension, review and sale of players' registrations. What on earth is all that about? I think we'll need to read that in a little bit more detail, won't we? So I might steer clear of that one. But that's 10 marks. Ooh, I need 5 marks, but there's a lot going on within that question, so we'll come back to that after. Part C wants us to go through there and look at taking account of some naming rights with regards to evaluation, and also the implications on the financial regulations imposed by the leagues. I have no idea what that last bit there means about the implications imposed by the leagues, but I know that it's 7 marks and 3.5 marks to pass. So I've got a very rough idea about the first one. I know it's about borrowing costs. The second and third one, that might give you a little bit of fear, but we'll break it down as we go along, because once we've got the specific requirements and identified them and how many marks, we need to think about which order we're going to attempt them in. So let's go back to those specific requirements. And I think the first one Part A, the borrowing costs. If you read the background information, I'll probably attempt that one first. Okay, it's probably the easier one of the lot, provided you know about borrowing costs. If you don't know about borrowing costs, what are you doing walking into the exam room? You need to know the rules. Okay. Part B, you can break it down. There's 10 marks. There's going to be a lot going on. We need to look at the acquisition, so that's one part. The extension of this registration, and then the review, and then the sale. So essentially there's 4, maybe 3 pieces within there that we can deal with individually. If you can break them down into smaller, more manageable aspects, then it makes the question much easier. Okay. But again, might want to steer clear of that just for the time being. Because part C, I see the word valuation. Have we covered a standard on valuation? Yes, we have. IFRS 13, fair value, haven't we? Okay. So there's a little bit of fair value within there. And then there's also an other bit, an and, magic letter. So there's something going on as well to do with financial regulation. So I'll need to read that in a bit more detail. Okay. So myself personally, I'd do A, I'd do C, noting that there's 2 parts to it, and then I'd have a play around with B. Okay. Knowing that in A, I need 3 marks. In C, I need 3.5. In B, I need 5 to be able to pass. Okay. So, how do I then go on with my approach? Well, for each one, I need to identify the accounting standards that are likely to be relevant. Clearly, that's easy in Part A. It's borrowing cost, but what about Part B? Okay, a little bit more of a challenge. And then I need to know what the basic rules are of each of those standards identified. So let's apply that specifically in Part A. Okay. So in Part A, we know that they are borrowing costs. Throw in I-23 if you want. Don't waste your time. But it's all about borrowing costs. It's an individual standard. The basic rules are all about when do we start capitalising, when do we stop capitalising, and are we using general or specific borrowings. Okay, and those borrowings are going to be capitalised if we have a qualifying asset, an asset that takes a substantial period of time to construct, isn't it? Ta-da! They're the rules. That's what we've gone through there and seen previously when we've chatted through our borrowing costs with our example. So if we have a qualifying asset, we capitalise it over the period of construction. Capitalisation starts, doesn't it, when we meet those 3 criteria. So when you've got expenditure, there's interest, so the borrowing costs, and we are actually constructing, so activities are taking place. We stop it when it's ready for use, or when we're not constructing it, essentially. And then if it's specific borrowings, we use the effective rate. If it's not specific and it's general, we use a weighted average rate, don't we? Okay. Remember that? Hopefully you do. Because if we apply it to what you've got within the question, when we start capitalising, I think it's the 1st of February 2016. That's when we commenced the construction of the stadium. That's when we were incurring the interest because it's coming from, I think, general borrowings. And there will be expenditure taking place as well. When do we stop capitalising? Well, we've got a year end, the 31st of May 16. We're still constructing at that point in time. So we will continue capitalising for February, March, April, May. For the 4 months of this year, it will also continue into future accounting periods. But we're not worried about the future. We're just worried about these 4 periods. And again, it talks about we're not using specific, but we're using general borrowings. And that's there is at 9%. Okay. Get enough marks out of that to pass comfortably. Okay. Borrowing costs. What do we know about it? Talk about the fact we can capitalise it. Talk about it's the construction of a new stadium. That being the qualifying asset because it takes a substantial period of time to construct. The capitalisation, when does it start? It starts when the asset is being constructed, when the costs are being incurred, when borrowing costs are being incurred, which is the 1st of February 2016. Nothing too difficult there. When do we stop? When do we finish? It will finish when all the activities are substantially complete and when it's ready for use. So that's in the next reporting period or maybe even further down the line. Okay, so we're going to capitalise them from February to May in this accounting period. I've said 3 things. I don't think any of them are particularly difficult. I've kept away from the numbers. I've got 3 marks. What have I done? Passed. Yeah, excellent. Yeah, that's it. I could move on if I wanted to, but there's other marks that I can get which should be pretty straightforward because I haven't even gone through and spoken about what interest rate I'm going to use. The interest rate that we're going to use is the 9%, which we're going to apply to the borrowings. Again, those borrowings are general. They are going to be a weighted average interest that's applied to the weighted borrowing, depending upon how many months the borrowings have been in place for. Okay. Another mark, that's 4 out of 6. That's 67%. Imagine if you walked out of this exam with 67%, you'd be so happy. Okay, wow, amazing. But can I get some of the other marks? Yeah, you can. But it's going through there and playing around with the numbers, isn't it? Okay, so here goes. Year ended May 2016. The borrowing costs have increased, haven't they, from February? We started off with 20 in February, and then 50 for each month until the end of the year. Okay, so that's another 3 months worth of 50. So we need to look at how much I've borrowed each month, how many months we have borrowed that amount for, and applying the interest rate to those borrowings for the length of time that we have borrowed for. So I've got February, March, April, May. I borrowed 20 in February, 50 in March, 50 in April, and 50 in May. Okay, what I'm doing here is different to what you see in the model answer, but it will give you the same answer. I think this is a little bit easier. Okay, too much excitement there. How many months did we borrow it for? Well, the borrowings I took out in February. I borrowed for February, March, April, May. The borrowings I took out in March, for March, April, May. The borrowings I took out in April. Yeah, you get it. April, May, and then May, just May. Okay. With me? So the interest, those 4 months at 9% at 20 million. So we need to prorate it for 4 months. That gives me 0.6 million. Okay. I then borrowed 50 million for 3 months. So 50 million multiplied by 9% multiplied by 3/12 gives me 1.125 million. The April borrowings for 2 months, 9% of 50 multiplied by 2/12 gives me 0.75. And then in May, 50 million times by 9%. 1/12 of that gives me 0.375. Okay. Excellent. Take those numbers, add them together. What do you get? 2.85 million. What's the answer in the model answer? 2.85. Is it done the same? Yes, it is. Exactly the same. Brilliant. Okay. So don't believe that you have to follow the model answer all the time. I've just demonstrated there that you can get the 2.85 million doing it in a much more straightforward, or I think much more straightforward manner. Okay, much more logical as well. Numbers, so probably 2 marks for that. Okay, takes you to the 6. If you didn't include any numbers, you can get 4, and you've comfortably passed the question. Okay, everybody happy with that there? Brilliant. I've done part C next, up to you, I don't know. The identification, I should say, of the accounting standard. I think when you read it through, the valuation is the key aspect, isn't it? Which is IFRS 13. And then I think if you go into the second part of the question, I think you're beginning to think about related parties, aren't we? Okay, IS 24. Okay, because you have these 2 directors on the boards of Emcee and an airline. Okay. The basic accounting standards, in terms of related parties, it's all about control and influence. Fair value, there you have it there. Okay. It's all about hierarchy, isn't it? You've got the definition of what fair value is there. You've got the level 1, the level 2 inputs. Okay. Level 1 is whereby it's traded on an active market, and level 2 is whereby it isn't. Okay. So I think in this question, I think we're moving towards level 2 inputs, as the naming rights aren't traded, are they, on an active market? But the most recent purchase price, I think, will give you good evidence, wouldn't it, of the fair value? Okay, excellent. So there we go. That's essentially what I've just said there. The fair value. The stadium naming rights are an indication of the fair value of the stadium. Don't jump in and say it's level 2. Explain why it's level 1. The standard adopts a hierarchical approach. Adopt the hierarchical approach in your answer. So it's not level 1 because the stadium and the naming rights are not traded in an active market. The offer of 100 is a level 2, as that is a price other than that in an active market. It's the most recent transaction price, so it's pretty good evidence of fair value. Therefore, what do we do with it? Well, it's the value of the stadium, so maybe revalue the stadium to 100 million and then depreciate that 100 million over the 3-year life. Okay, there we go. If you can get all of those, I think you're looking for 3 marks. Okay. In terms of the related parties, A related party is related if one party has control or influence over the other party. The directors on the management board of Emcee are a related party of Emcee, as they are key management personnel. Okay. They are also related parties of the airline. Okay. So what you've got is you've got Emcee, you've got the airline, and these directors are directors of each of the airline and Emcee. Okay. Key question there is, are these two companies, Emcee and the airline, related because they have common directors? Okay. The answer is no. Okay. Yeah. It actually says so in the standard. Okay. If you go through and have a look at IS 24, it says that they are not. Okay. The standard takes the view that it's very difficult for directors or directors that are in common to be able to exert sufficient control or influence over both of those entities at the same time. Okay. There's other directors, isn't there, on those boards of the airline and of Emcee. So the standard deems that that doesn't give them a significant level of control or influence. Okay. Although individually, they are key management personnel. The remuneration will be disclosed for working for the airline, for working for Emcee. Emcee and the airline are not related parties, okay, because they don't have sufficient control or influence to those directors over both the parties. Okay, bit of a funny one, so do just be aware. If you get it though, that last bit you might not get, so lose a mark. But by talking about what a related party is, talking about that they are related parties to the individual entities, will get you 2. So that there's good marks to get in there, which would see you to get a pass. The last bit, I think, was just a little bit nasty. It did ask you to talk about the financial regulations, didn't it? The financial regulations talks about the prevention of capital contributions. The aim is to propose or promote sustainable business models. There are rules, I think it says, about related parties with regards to what the financial regulations state. So that even though IS 24 states that they're not related parties, we need to look at the financial regulations to see whether or not that states that they are related parties. Okay, not so much from an accounting perspective, but just in case it goes through there and breaches any of the rules by which we are governed by. Okay, because if so, that could have an implication in terms of financial irregularities and could lead to fines or penalties. Okay, whether that's a fine or a penalty with regard to points deductions, because I think it's a sports club, isn't it? Or it could be a monetary fine. If there's a monetary fine that we've broken, then we might need to provide for it, but that's a separate issue. Okay, I think just for one mark there, you could talk about the regulations, and we need to do a little bit more detailed work about what is contained within the regulations. So that will give you the 7 out of the 7 marks. Part B, woo, rock solid, really hard. Identify the accounting standards that are likely to be relevant. The ones that I came up with, when it talks about an acquisition of a player and the extension of its contract, so I think that's to do with an intangible, isn't it? The registration, so we're acquiring an intangible asset, the right to be able to use that player for the foreseeable future. The review, I think, might indicate, is it an impairment when we review the usefulness of that player to our business, so our sports club. And then the sale of the player's registration could be deemed to be a non-current asset held for sale. Okay, yeah, quite challenging there. But if you've got 10 marks, there's likely to be more than one accounting standard, isn't there? The basic rules, there you have them. Separate acquisition of an intangible, capitalise it at cost and amortise it. The impairment, identify the impairment based upon any external factors or internal factors. Look at the impairment comparing the carrying value to the recoverable amount, and if the carrying value is greater than the recoverable amount, it is impaired. And then if you're looking at a non-current asset held for sale, that sale needs to be highly probable. Okay, so if that's the case, we need to be selling the player within less than a year. We need to be actively selling it. We need to be locating a buyer. If we're doing that, then we can record it as a non-current asset held for sale. We can stop amortizing it, and it will be classified as part of current assets. It will be classified as current assets at the lower the carrying value and fair value less cost to sell. If we classify it at the fair value less cost to sell being lower. Any reduction in value from the carrying value to that fair value less cost to sell is an impairment through profit or loss. Sound familiar? Those rules, if you're struggling, just write them down on the page of paper. Okay, it will get you some credit, but don't do that all the time. Okay, so separate it out. We said that there was at least 3 or 4 areas, didn't we? So the first one is the acquisition of the player. Okay, I think it's a bit of a challenge to identify that it's an intangible, but make sure that you state it in there. Give rise to an intangible asset, capitalise it at cost, amortise it over the life of the contract, and that cost will include all the fees. It does even mention the fees, transfer fees, league levy fees, and player agent fees. They are all capitalised. They are all directly attributable costs, aren't they? Okay. It goes on to talk about contingent consideration. What on earth? So that's an amount that we will pay more depending upon certain targets are met. Maybe if the player scores so many goals or so many baskets, if it's there to do with basketball or football, or maybe if there's a level of success that the football team or the basketball team reaches. Maybe it's successful in Europe, I don't know. How can we know whether or not we're going to be successful? Very difficult to identify, isn't it? So don't start thinking, well, there's no probable outflow of economic benefit, there's no obligation, so therefore there's no liability. We look at it based upon the fair value of that consideration, don't we? Okay, we measure the fair value based upon what we could potentially expect to pay and receive, and then we add that to the initial cost. Okay, we then take the total cost and then amortize that over the life of the player's contract. Okay, 3 points, 3 reasonable marks. Okay, if you wanted any change in fair value, subsequently we'll go to profit or loss in future period, but nonsense, who cares? Okay, I'm not worried about that for the time being. The extension, so if you extend the contract, there's going to be some more fees to pay, aren't there? So we then go through there and capitalise those additional fees, and then we go through and take those fees and amortise the value of that player now over the remaining life of the contract, isn't it? Okay. It could be that partway through the player's contract we decide to go through and extend the contract, or it could be that at the end of the contract, when it's down to 0 years, we then start up a new contract. Okay, key bit is that whenever we do it, we look at what's left in total and then amortize the new cost, or I should say the new cost plus carrying value over the life of the contract. Again, a nice mark there. Okay, it gets a little bit harder then as we move on, doesn't it, in terms of the review. It says that at the end of every season, so in the second paragraph, the club reviews its playing staff and makes decisions as to whether to sell any players' registrations. Okay. So maybe there's a potential, is there for an impairment. Okay. When we review the registration, are the players injured? Are they looking to move elsewhere? You just don't know. So it could be that review highlights the evidence of an impairment, put in an example. If that's the case, we compare the carrying value to the recoverable amount, and we can explain that there. If the carrying amount is then greater, then the intangible is impaired down to the recoverable amount, and then that amount is recognised through profit or loss. There isn't too much that you can go through there and really say, okay, within that section. I think it's difficult to say, look, that you need to identify that there is an impairment. But I think, I'm not saying that there is, but the potential for impairment. So whenever we do the review with regard to selling it, there's also the possibility as well that if things happen, then maybe that will be the impairment. In that second paragraph, it says occasionally it becomes clear that a player will not play for the club again because of a player sustaining a career-threatening injury, okay, or being removed from the squad for another reason. Oh, the players have been naughty. So that would be the bit that brings you towards the impairment, okay. In terms of the sale of the players, when you carry the review and you look to sell the registrations, you will classify it as a non-current asset held for sale if it's highly probable. Lower the carrying value and fair value less cost to sell, with any reduction shown as an impairment through profit or loss. And then ultimately the final sale of that player gives rise to a profit or loss on disposal, doesn't it, as we say at the bottom. Again, that goes through profit or loss. If you wanted to go through there and be a little bit fancy, I do think in that last section, the last sentence of the second paragraph, it says the player registrations of certain players were sold after the year end. So if anything happens after the year end, it's an event after the reporting period, isn't it? The total proceeds net of cost of 25. The registrations had a net book value of $7 million. You would then need to determine whether or not that is an adjusting or a non-adjusting event. Okay. If that sale gives evidence of a condition that existed when we were looking to sell the player, then maybe that does give rise to an adjusting event, and we can use the 25 million as our proceeds to record a profit or loss at the end of the year, as opposed to disclosing it as a non-current asset held for sale. Okay, so given that before the financial statements were signed, the player was then sold, we can remove the player from the books at that year end. Okay, but that would just be bonus mark that you could then potentially get. Okay, other than that, wow. Okay, that last one was a real challenge, wasn't it? But as I said, the more marks that you get within a question, the more challenging it tends to be. And the reason why it's more challenging is because there tend to be more accounting standards that are there to discuss within the question. If you can identify the basic fundamental accounting standard, which on this one I think was the intangible, if you score well on that, you're going to push yourselves up to getting a pass mark. Okay, try and split out your answer as much as possible. So here we had the sale of the players, we had the review of the players, and we had the extension as well as the acquisition. The more you split it out, the easier it becomes to go through and score those marks. Okay. Like I suggest with all of these written questions, write it out yourself. Go through, look at the question, do it without my answer that you've seen here, do it without the model answer that you see on the ACCA website, and write it out yourself. The more you get practice at answering these type of questions and understanding how you write and what you need to write, then the better it will be come any exam situation. So stick at it. Don't keep practicing the numerical questions in part A of question 1 and say, yeah, I'm a genius at consolidations. The better you do on these, the better you will do overall on the exam. So keep up the hard work, keep the revising going, and keep practicing those questions. Good luck.